Because first of all, let me just cut you short. The main reason why these people cut rates was actually for corporates to survive. You see, the best example is this. Let's say Safaricom today, we are getting into a recession, and Safaricom, let's say, is firing everyone. You see, so the moment Safaricom fires a lot of people, already let's say Safaricom is one of the top employers. Okay. And now they are facing that risk of firing people, so they need money. You see.
Yep.
So the fact that now Safaricom can go to banks and get loans at almost like at a free rate, they do that. You see. So now as Safaricom goes, borrows money, comes. So these people who are to be fired, wanapata some luck, wanabaki kwa job. So because Safaricom now has borrowed money, so our workers are now still able to remain in employment, and that is one way they counter that unemployment skyrocketing. Now for the Fed, they have a 4% target maximum. That should be the target. Less than 4%. No,
inflation.
Unemployment rate.
Okay.
Like not more than 4%. So right now it's about a 3.6%. The market
back when COVID started, we went as high as
20-25%.
High, yeah?
Yeah, it went too high. Yeah. So already for that, as I was saying, they've already countered that. So like raising rates to and already markets are too high from where the COVID high we were. I think COVID high was at around, for the Dow was.
Let me check.
Yeah. So like markets are more than 100% actually from the COVID low.
For the Dow, it was 29,000. Just came shy 30,000.
Yeah, and
now
we tapped a high of
37 roughly.
Yeah, exactly. So like markets are already too high from like where we were before the COVID pandemic, which basically brought all these interest rate, low interest rate environments and all this pumping of money. So the fact that the market is already way ahead of where it was even before COVID started. And I know, like basically the markets. If you look at the stock markets, like S&P 500, it covers basically it's a summary of basically how the economy of the US is working. So basically, when such an index is doing so good, it means like companies a company stocks is rising. Basically, company stocks rise. Now they may rise even to a high more than where they were before all this COVID started. So. Basically trying to bring back the normal market, like where the market was before all these risks came into the market. So trying to bring back the market back to that 1.7% interest rate is not now a big risk. Because I think that is why they were very skeptical on raising rates before even. Because I remember before, like back in 2020, like before I understood the whole interest rate environment and how it works. For me, I knew that markets will make a small pullback and continue with the bearish trend. But the markets made new highs almost every other month.
Expecting it to continue.
Yeah, exactly, that high. So for me, I believe I don't know why they like personally why their reason, but for me, I think is that reason that the market is already doing too good in terms of where we are, the position where we are at in terms of even asset prices. The dollar had a very tough year also. So now the Fed is trying to also make the dollar, as Ken was saying, sometimes in a recession you can choose to devalue your currency, but you also have to be very smart about bringing it back up. So at least it's quicker. I think you remember, and also like the point you asked Ken about inflation. Why do they have to control inflation? Yeah. Because if you don't control inflation, the risk of hyperinflation is now going to face you. So basically,
inflation that will skyrocket the price.
Exactly. Like it's uncontrollable. Even you can't raise. Like you can't do anything. You can't raise rates to.
What happened? Was it Venezuela?
Yeah, Venezuela, Zimbabwe, such countries. Yeah, and it's because such countries. If you look at Zimbabwe, it was just stupid policies. Like that, the president was always like, why are you guys saying you don't have money? See, we just print. See, so the fact that they were just printing money devalued the Zimbabwean dollar so much until I think it was actually lifted off from the currency. Yeah. So such stuff. So for me, I think it's you try and see where is the market environment and see what are the risks. Like back in 2020, 2021, if they had rose interest rates, maybe there was that risk of what if they tamper again with growth. But for now, I think the market has grown already too much. See, so they need to also regulate that. So I think that is the reason why they Powell was saying they have room to raise rates but not tamper with growth and unemployment.
Okay, makes sense. And Ken, what's the disadvantage of high inflation?
What's the disadvantage of high
Inflation.
Okay.
Like why does the Feds need to come in and act?
Okay, you just have to think about the purchasing power of money. So inflation is basically the purchasing power of money losing value. So if you have 1,000 shillings and inflation is sitting at 2%, then it means with your 1,000 shillings you can buy particular goods or you can pay for a particular service. But once inflation jumps to 7%, it means that the 1,000 bob you had cannot buy some certain things. So you will need to spend more money to acquire the same things. Basically, money is losing value. And no one likes operating with money when it's losing value. No country would like their currency to be completely devalued. There are situations where it's right to devalue a currency. For example, when you're in a crisis, when you're in a recession, it's always wise to devalue a currency. But sometimes when the economy is doing so well, when an economy is doing so well and inflation is also so high, then even the economy doing well is not valuable. Because as much as there's growth, there's also inflation. And if inflation is countering growth, then it doesn't really work out well. Because still, as you're growing, you still have to spend more. So it's not really growth that is taking place because there's high inflation. And that's why the Feds have to come in and drop down inflation to a moderate rate. So if you look at it historically, inflation has always or will always try and sit below 2%. So 2% is the target range of the Feds. Even annual inflation sits at 2%, it's fine. But after COVID and the pumping of money, like you guys said, I was explaining very well. So the pumping in of money, too much liquidity came into the market. And so there was very, very easy money.
How much was pumped in total so far in the past 2-3 years?
About $6 trillion.
And that's just from the US. If you look at worldwide, a global
that's a lot of money.
A lot of money, because Euro also had the QEs
stimulus.
and stuff.
In Kenya, we also had them. So globally across the world, I think the basic idea we can start with is we are moving. Markets operate in cycles. We have bullish times, we have bearish time. We have times when investors are optimistic, we have time when people turn pessimistic. We have times when people are greedy, and we have times when people become fearful. And so the pendulum will always swing between these things. So we'll always have a swing between those emotions, views, and everything, which are somehow connected. For example, when people are so optimistic, they tend to be greedy. And when they're greedy, they tend to take too much risk. And when they take too much risk, they bring in frothiness. For example, if you look like at a coin like Bitcoin, like a specific asset like Bitcoin, we saw Bitcoin come from 5,000 all the way to 65,000. That brought in a lot of optimism. Bitcoin is going to the moon. We saw a lot of money coming in. We saw a lot of people operating on fear of missing out. We saw a lot of new money into the market. Irrational exuberance. And now we are swimming from that, again, back to fear, panic, pessimism. Will it work really? Is it a worthy technology?
That's the tone in the market
That's the tone in the market back again. So it's a normal cycle, which will always operate up, down, up, down, up, down, up, down.
With a long trajectory.
Exactly. In the long run, productivity is moving higher. And so that's what is happening currently. So for me, I think, because you guys have both explained the cycle and the interest rates, I think what I can touch on is assets. So first of all, people need to understand the relationship between the economy and the markets. I think that is something that many people don't understand. So first of all, markets will always be ahead of the economy. So markets won't wait for the economy to start going down for markets to go down. No. So markets are always ahead of economic reality.